Today, taper first or lift rates first? Does it really matter? Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and problem news with a distinctively Australian flavour. Here is a riddle for you this Friday. When central banks, who've taken interest rates artificially low and pumped up markets by various forms of asset purchases and money creation, decides it's time to reverse course, if they can, do they reduce asset purchases first or lift rates first? Well, yesterday, as we discussed, the Fed signalled a faster rate of tapering, meaning they're buying smaller amounts of government bonds before lifting rates. And they said they cannot also lift rates at the same time, as this would confuse the markets. But in the UK, the Bank of England just did the opposite. They lifted the cash rate just a little, whilst maintaining asset purchases. Now, I'll look at the Bank of England statement in more detail in just a bit, but before I do, it's worth noting that the Fed's upward shift and acceleration in rate hikes over the next 3 years is very evident, but the long-run projection for the terminal rate is unchanged. The Fed's governors still believe that rates will never need to go higher than 2.5%, where Fed funds peaked in 2019 during the abortive attempt to return rates to normal after the financial crisis. There is still no belief at the Fed that inflationary conditions are normalising, or that we are returning to the kind of pre-2008 world where central bank vigilance against rising prices will once more need to be a fact of life. Instead, there's a hope that inflation can be brought under control with relative ease. The markets appear to endorse this, and also to believe that there will be no need for the extra rate hikes in 2023 and 2024, as predicted in that dot plot. As John Authors at Bloomberg wrote, if Powell wanted the markets to do the central bank's job and tighten conditions, it conspicuously failed to do so. Perhaps more notably, real yields shot up after the announcement, only to dive lower during the press remarks. By the end of the afternoon, the real 10-year interest rate was back below -1%, which is not tenable if a central bank is fighting inflation. For all the world, he said, it looks as though the Fed chairman tipped the wink to his audience that he wasn't going to try too hard to contain inflation and not to worry. For yet another sign of the same pattern, stocks zoomed back up close to all-time highs. So now to the Bank of England's Monetary Policy Committee meeting, where the MPC voted by a majority of 8-1 to increase the bank rate in the UK by 0.15 percentage points to 0.25%. They said the committee voted unanimously for the Bank of England to maintain the stock of sterling, non-financial investment-grade corporate bond purchases financed by the issuance of central bank reserves at £20 billion. And the committee also voted unanimously to maintain the stock of UK government bond purchases financed by the issuance of central bank reserves at £875 billion, and so the total target stock of asset purchases is £895 billion. And in the MPC's central projections in the November Monetary Policy Report, global and UK GDP were both expected to recover further from the effects of COVID-19 in the near term. Conditioned on the rising path for bank rate expected by financial markets at the time, upward pressure on CPI inflation was expected to dissipate over time as supply disruption eased, global demand rebalanced from goods to services, and energy prices stopped rising. Earnings growth was also expected to fall back from its current rate. As a result, inflation was projected to fall back materially from the second half of next year. Since the November MPC meeting, the Omicron COVID variant has emerged and it appears to be spreading rapidly within the United Kingdom and around the world. The new variant appears to be much more transmissible than the Delta variant and, on the basis of current knowledge, poses new risks to public health. Global risky asset prices fell in response to this news, but have since largely recovered. Longer-term advanced economy government bond yields have declined. The level of global GDP in 2021 quarter four is likely to be broadly in line with the November report projection, they said, but consumer price inflation in advanced economies has risen by more than expected. The Omicron variant poses downside risk to activity in early 2022, although the balance of its effects on demand and supply and hence on medium-term global inflationary pressure is unclear. Global cost pressures have remained strong. Bank staff have revised down their expectations for the level of UK GDP in 2021 quarter four by around 0.5% since the November report, leaving GDP around 1.5% below its pre-COVID level. Growth in many sectors has continued to be restrained by disruption in supply chains and shortages of labour, and the impact of the Omicron variant, associated additional measures introduced by the UK government and devolved administrations and voluntary social distancing will push down on GDP in December and in 2022 quarter one. The experience since March 2020 suggests that successive waves of COVID appear to have had less impact on GDP, though there is uncertainty around the extent to which that will prove to be the case on this occasion. The Labour Force Survey unemployment rate fell to 4.2% in the 3 months to October, while the number of payrolled employees continued to rise strongly in November. There is little sign in the available data that the closure of the coronavirus job retention scheme at the end of September has led to a weakening in the labour market. The employment rate is now expected to fall to around 4% in 2021 quarter four, compared with the 4.5% projection in the November report. And bank staff continue to estimate that underlying earnings growth has remained above pre-pandemic rates, and the committee continues to see upside risks around the projection for pay in the November report. 12-month CPI inflation rose from 3.1% in September to 5.1% in November, triggering the exchange of open letters between the Governor and the Chancellor of the Exchequer. Relative to the November report projection, there has been significant upside news in core goods and, to a lesser extent, services price inflation. Bank staff expects inflation to remain around 5% through the majority of the winter period and to peak at around 6% in April 2022, with that further increase accounted for predominantly by the lagged impacts on utility bills of developments in wholesale gas prices. Indicators of cost and price pressures have remained at historically elevated levels recently, and contacts of the bank's agents expect further price increases next year, driven in large part by pay and energy costs. CPI inflation is still expected to fall back in the second half of next year. The MPC's remit is clear that the inflation target applies at all times, reflecting the primacy of price stability in the UK monetary policy framework. The framework also recognises that there will be occasions when inflation will depart from the target as a result of shocks and disturbances. In the recent unprecedented circumstances, the economy has been subject to very large and repeated shocks. Given the lag between changes in monetary policy and their effects on inflation, the committee, in judging the appropriate policy stance, will, as always, they say, focus on the medium-term prospects for inflation, including medium-term inflation expectations rather than factors that are likely to be transient. At its November meeting, the committee judged that provided the incoming data, particularly on the labour market, were broadly in line with the central projections in the November monetary policy report, it would be necessary over coming months to increase bank rate in order to return CPI inflation sustainably to the 2% target. Recent economic developments suggest that these conditions have been met. The labour market is tight and has continued to tighten, and there are some signs of greater persistence in domestic cost and price pressures. Although the Omicron variant is likely to weigh on near-term activity, its impact on medium-term inflation pressures is unclear at this stage. So the committee judges that an increase in the bank rate of 0.15 percentage points is warranted at this meeting. In response, of course, investors scrambled to sell UK government bonds and priced in a more aggressive tightening cycle, because that was an unexpected outcome. The yield on 30-year benchmark bonds jumped 10 basis points on Thursday to 1%, and that's the highest level since November. So the Bank of England raised its key rate to 0.25% despite concerns about the coronavirus infections, which may have clouded the economic outlook. Now, traders are betting that the Bank of England will raise rates by another 25 basis points to 0.5% by March to tackle the highest inflation in more than a decade. That would allow the Bank of England to immediately bring to an end its policy of reinvesting its expired QE bond holdings. The market expects officials will eventually increase the key rate to 1% by August, compared with November previously. Money markets had 7 basis points away from pricing a quarter percentage point hike to 0.5% at the Bank of England's February meeting, a level that could pave the way for the central bank to start letting bonds in its balance sheet mature without reinvesting the proceeds. The Bank of England move comes as the Monetary Policy Committee battles the dual threats of the Omicron variant, prompting new restrictions and the fastest inflation in more than a decade. Economists at Nomura Holdings and Berenberg were in the minority of forecasters who expected that 15 basis point hike on Thursday, and they're calling for an even steeper increase in February. The 50-50 knife edge MPC decision today fell on the side of combating inflation as opposed to fears of Omicron, said Craig Inches, Royal London Asset Management head of rates and cash. The MPC will be cautious in its approach to raise rates in 2022. However, a move to 0.5% is likely in February. The pound rallied by as much as 0.8% to a 3-year high of 1.3374. Gilt yields paired their advance with 30-year rates trimmed an earlier ascent, which got to 10 basis points. Delaying the hike amid elevated uncertainty, as most pundits expected, would have been understandable, said Holger Schmeling, an economist at Berenberg. But it would not really have made sense. Inflation pressures are elevated and look set to remain so in the UK. A move to 0.5% in February is seen as the threshold after which policymakers may let bonds that mature in its £875 billion, which is, by the way, is about $1.2 trillion, asset purchase programme, roll out of the portfolio without being replaced. It could therefore determine whether the central bank reinvests £28 billion of proceeds from bonds maturing in March. And in addition to expectations for February, traders also see the central bank's key rate going to 1% by September, compared with November previously. The Bank of England has previously indicated it will consider selling the bonds it owns directly once borrowing costs climb to that level. So a couple of observations here. First, well, talk from central banks is cheap. Second, the markets continue to believe that central banks are going to save them. And third, rates are expected to stay low, so low that I'm not sure very much has changed at all. As I've said before, ignore what they say, let's see what they do. And the suggestion I would leave you with today is that really they're considering doing very little. Consider it more like moving the car around the cul-de-sac than driving out. So in actual fact, whether you lift interest rates slightly or tapering a tad doesn't seem to me to make much difference. They are still fiddling while Rome burns. Now, if you're buying your home in Sydney's contentious market, you don't need to stand alone. This is the time you need to have Edwin Almeida from Ribbon Property Consultants standing alongside you. Buying a property is both challenging and adversarial. The vendor has a professional on their side. Emotions run high, price discovery and price transparency are hard to find, and then there's the wasted time and financial investments that you make. Edwin understands your needs, so why not engage a licensed professional to stand alongside you? With RPC, you know you have experience, knowledge, and master negotiators looking after your best interests. So shoot Ribbon an email at info@ribbonproperty.com.au, and if you use the promo code DFAWTW/Martin, you can get a 10% discount offer. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.